course.
And we are live on Us Property Investors. We bring the big names and we have the big fun. And we have a guest. I've organized somebody and an amazing co-host with this session. But it's going to be huge in this one because we're going to talk about, well, where are investors considering? Why are they selling? Is there going to be a market reset coming for investors? Very controversial and outlandish, perhaps. But Steve Felice's article sort of dovetailed into that. And he said 10 years investing is going to be finished. So I don't know about that. But we'll unpack why investors are selling and even locations. Or some locations that I'll sort of focus on as well. So if you have an area you want us to unpack, it'll only be one because I want Mike as the star of the show. So Mike, how are you going?
I'm doing well, mate. Thanks for having me back.
No, you're welcome. Thanks for, particularly you had a huge day today down in Sydney, I believe, with some commercial property people, which you made some cool jokes apparently, and people were fascinated with where you took things. So we won't say where we took. And Heather, how are you going? Anyway, what's happening?
Hey, I'm so good. It's fun to be here. Thanks for having me.
Yeah, you're welcome. And thanks for jumping on and supporting us. And Joe had his surgery. I don't know. I don't want to make around how is Joe going. But he did have surgery today. So he will be back at some stage, maybe in 2025, maybe at some stage in 2026. We'll see. But as I said, I'm excited about this session because there is a little known survey. Maybe it's not little. It's a little bit bigger. PIPA that do this, and it's almost 1,000 investors. So there's a lot of information, a lot of data. So this is, I wouldn't necessarily say market moving because I don't want to put so much brevity shortness, but I don't want to put so much on that pressure on that survey. But it is really, I suppose, illustrative as to what investors are thinking of. And I'll let Mike do further justice to it. But before we get to that, I want to introduce to you the illustrious guest and the illustrious co-host we have on tonight. Mike, you are from MCG Quantity Surveyors. You've done your Q at quantity surveying for depreciation consultant for places like McDonald's, Canberra Airport, Hilton, Stockland. You're regular in the AFR, realestate.com. And the thing I loved, I say this every time, it's really fun. You're a keen musician, apparently, and an elite amateur triathlete. So I know you sort of debunk that every time, but I think you probably are a little bit more competitive than what you probably let on. And also with us, we have Heather Jordan, who is an amazing accountant, and I suppose more around focusing on that holistic accounting planning. So she's doing some amazing stuff. Also a money expert, founder of Money Wise Co. And Jordan Advisory, I believe. That's how I better say that. 20 years, though, you've helped businesses and individuals create those wealth. So, Mike, tell us about this survey, though.
Yes. So the annual investor survey is really, really important for PIPA. And I would argue for property investors more as well as property investment professionals, because it enables us to take the pulse of how investors are feeling, and that kind of informs advocacy and strategy work that PIPA does. For example, if we think about some legislation that came in Queensland, where they were talking about those land tax changes. I think Todd Sloan did a great little video where he was talking about getting a cup of coffee in Adelaide and then in Victoria, and that affected the price of his cup of coffee in Melbourne. That was something that PIPA got onto the front foot with in concert with the REIQ. And I really believe those two institutions together are the reason why that legislation was repealed. I think that would have been a terrible thing for property investors. And, there's examples of things that can't be stopped, like the Victorian land tax down there. But PIPA is really important because investors aren't necessarily supported at things like the state policy and residential tenancies, and we kind of need people to understand the value that investors bring. So this is an opportunity for people to share how they're feeling, where they might be selling property and for what reasons, where they're looking at buying, what their cash flow looks like. So it's a really good snapshot, and I'd like to thank the group for participating as we put that up, and we had some submissions there as well.
You're welcome. So
850 people answered that survey. That's pretty hectic, and I think and that's all across Australia.
Yes, yeah,
amazing.
Yeah, I mean, we would love it to be more. There's over 1 million property investors, and the more data that we can get, the better on that. But even with that sample size, which we would ideally like to be 1,000 plus, it does give us a pretty good insight into how investors are feeling.
Yeah. which I think is fascinating. So the Property Investment Professionals of Australia is what PIPA stands for. And the way that I understand it is that they are promoting, like they're the voice for investors. So they're our voice.
Well, in the Property Investment Professionals of Australia, so there is actually an investor institute. That's the Property Investors Council of Australia. So PICA and PIPA work quite closely together, as we do with REBA, the Real Estate Buyers Agents Association. So PIPA is really designed for the property investment professionals, which of course then helps the consumer. So it's all about making sure that we've got industry standards, where we have members that are doing CPD, they're adequately insured. And it has also a complaints handling mechanism within it. So if you are working with, let's say, a mortgage broker or a financial planner or a buyer's agent that's part of PIPA, and something was to go wrong or there was something to happen, then you've got sort of recourse to accelerate that. And unfortunately, the barriers to entry in property advice in certain sectors are very, very low. So we do kind of want that protection. At the end of the day, it's big biscuits, it's people's livelihoods and financial futures. So that's what we're all about, is protecting the people by upskilling the professionals in the industry and keeping them on the right track.
There you go. I think it's important sort of information and data and advocacy that is happening out there. So what are we sort of, I want to unpack, give us the executive summary, Mike. I know that's a big pressure for you to do, but tell us what the core market sort of issues you're sort of seeing in the sentiment, and what are the main takeaways for people and then we'll start to unpack those things about where people are looking to buy. Are they looking to sell as well? And put some locations in the comments as well, people, because I will give a bonus little unpack for 5 minutes in about 40 minutes. So stay tuned, because there will be that as well. But Mike, tell us the core things that you found.
I'll give you a bit of an elevator pitch. So, for example, 16.7% of investors sold at least one property in the past year, and that's the highest level in the survey's history, up from 14.1% in 2024. So, obviously, that's a concern, and it has some implications for rental affordability. Of course, we saw the September quarter inflation print surprise on the upside. We're now at 3%. Was
anybody surprised by that, Mike? Though, I mean, with these electricity subsidies coming off, it was going to rebound quite a little bit, maybe I would say.
Yeah. I mean, that I suppose the RBA is willing to look through. But the reason why I brought that up is because in that quarter, we had a 2.4% rise in rents, which I think is quite meaningful, and I think that is something that's quite sticky. Of course, if you think pre-pandemic, the growth of rental yields was below CPI. We just saw this rapid pace of change, and things were cooling a little bit, but it seems like we've had a little bit of an extra sprint in rent. So investors selling off is not necessarily a good thing. Of course, when we look to the locations of where people are selling, it makes sense. But on the inverse, it's now the area that has a little bit of opportunity for investors. So 22.1% were selling in Melbourne, as distinct from 19.7% in Brisbane and 11% in Perth. And only 42% of those dwellings sold were bought by other investors. The rest were owner-occupiers and first home buyers. Some of the things in terms of like cash flow, 39% of investors faced operating cost increases of 11 to 20%. And Heather was mentioned, one of her big takeaways was that 8% of investors are now drawing on savings to manage the cash flow shortfalls, which is interesting because we did hear some commentary from tenants' unions and uninformed commentators to say, okay, well, like investors just pass on all the costs to the tenant, but we know that that's actually not true, and this survey really sort of bears that out. Then I suppose we should talk about what investors are concerned about. So 53% of investors said that they would stop investing if negative gearing would change. 35% would exit if the capital gains tax discount was halved.
Did it break down? Sorry, I know this is because we should set the scene, because Heather asked a very good point about who actually can take this survey, and it is current investors. But did it break down if you had 8 properties, you would sort of stop investing? Was it a high proportion, or did it sort of look like you don't know that data that deep?
No, it wasn't segmented in that way. So, and then I suppose if we think about investors selling, I mean, it depends what story we're trying to sell. I mean, there will definitely be some investors selling because they believe that they're at the peak of the market. I mean, if we look at all the capitals across Australia, all but 3 of them are at the peak of the market. So there's probably, some profit taking, and many people are reaching a stage of life where they're wanting to sell down some of that debt and consolidate. But it like the big takeaway for me is that investors just really want policy certainty. And I don't feel like we've had policy certainty all the way back to perhaps 2017, when we had the first sort of election where negative gearing was on the chopping block. They tried that again, none from 2. I think they're a little bit gun shy on that, but it's a conversation that we just have every year, every election cycle. It comes up over and over again. And I think investors are just kind of saying, look, we just kind of want to know that the playing field is going to be set in place for a period of time. I mean, there's one of the old sort of tenets of property investing is that you buy and hold, you never sell. I think that's been challenged in the last little while when we're seeing markets like Perth and Darwin giving these double-digit growths, and certainly some buyers agents, as part of their strategy, are saying we get in here, the market goes to this, we don't see long-term fundamentals, and we're selling. But most investors are buying something and they're holding it for 10, 20, 30 years. And how can you make that decision when every second year it kind of seems like we're going to cut this, or we're going to scrap negative gearing? And that has really irritated property investors, and that's been borne out in the survey.
Yeah. And over to you, Heather, because the short, not to I don't want to pigeonhole you, but I'll suppose expose some of your property sort of mastery, I would say, because you are a little fairly active in the property flipping space. Are you seeing that there's and I'm dovetailing off Mike's sort of point about, I consider a flip, yes, there's the renovation, but there's also the people that are deliberately entering a market to then sort of offload the properties. Are you seeing more? I think apparently, yes, somebody's upset about property flipping, but no. So on that, oh, good. On that point, are you seeing more and more people coming to those communities and saying, well, hey, it's too hard to buy in, I'm going to buy a property, flip it, and then move it on elsewhere, whether that be renovating or buying a particular spot and then deciding to sell? Is that what you're seeing as well, Heather?
Yeah, so, I mean, property flipping has definitely changed in the last 5 years. Yeah. The margins are not the same as what they were. And we've got a lot more people coming in because people are saying, okay, well, now I see that it's a chunk cash strategy. It means that I can potentially get into a property, whereas maybe before they thought that they couldn't. And so what I love about property flipping is that I feel it's very safe. So all those things that Mike just mentioned about policy and all those things almost go away for me when I'm property flipping, because I'm in and out in a very select period of time. And I'm managing the growth. I'm not waiting on markets or anything like that. And so, but what we're seeing is that people are finding it hard to even find a flip. Now, there's still plenty out there, and I'm not saying that it's the end of flipping. I'm just saying it's not lucrative like it was. And I think people who haven't given it a go before are looking at it going, this is really hard. I had somebody comment on a post I put on an accountant's page saying, I said, they were talking about somebody needing money. And I'm like, hey, listen, like I will tell anybody who listens, do a property flip. Like it's money in the next few months and significant money. And they immediately said, oh yeah, like easy money. I'm thinking, I've never told anybody it's easy money. That was not part of the equation. So the property flipping, it is happening. It helps you avoid those things that Mike was talking about. But yeah, it's not as lucrative as it was. That's for sure.
Before we go in, I'm just going to say, I'm going to put this disclaimer up. I should try and do it at the start of the show. This information is general in nature, not taking into account your personal needs or objectives. Please speak to your professionals, such as your Heather and your Mike as well. So now that we've got that out of the way, Joe tells me to do that at the start of the show now. So he's got me on I sort of missed 15 minutes there, but that's okay. So, but Mike, what aside from the government policy, the costs, the challenges, what are the things that you're seeing, and whether it be anecdotally or from the data, what is worrying investors about property?
Yeah, well, I think the policy concerns is the big one. 91% cite government interference, and you could. That's a big umbrella, like rental caps, tenancy reforms, minimum standards. They're citing 91% are citing that as the top threat to their strategy. But it's not all bad news. I mean, 59% believe now's a good time to invest, which is up pretty sharply from 45.7% the previous year. 28% of respondents purchased a property in the past 12 months, which is marginally up from 24%. And interestingly, Melbourne led the charge as the location where investors were selling the most at 22.1%, but Melbourne has emerged as the most popular investment target at 41%, followed by Brisbane at 16.5%. And Jeff, you wanted to talk about...
I think Mike's frozen. All right.
Oh, are we still there?
He's back.
There he is.
Where did you lose me? Sorry.
So you said Melbourne led the charge at 41%, which is interesting, and then you said Brisbane was at about 16%, and then
yes.
you're giving us something spicy about what we wanted to talk about. Where are we talking about further there?
Yeah, so Melbourne was the location where most property investors were selling, but it's also now emerged as the most popular investment target. So 41% of the respondents were saying that Melbourne was their most popular location. And I did promise some data from our little black box, where I think maybe the last time we caught up, it was really about the story of the rise of Perth. I was sharing the average distance between where property investors live and where they buy. Pre-pandemic, the first time we did that, it was 296. Mid-pandemic, it went to 500, it went to 800, it went to over 1,000, and it peaked at 2,000 kilometres. The average distance people buy an investment property from where they sleep at night is 2,000 kilometres, and that really was the story of the rise of Perth, because the majority of property investors are located on the eastern seaboard, and Perth is a bloody long way away. So Queensland, before the rise of Perth, was kind of the perennial number one, but hot off the press in data that we've crunched up to October, Victoria has just overtaken Queensland with 32% of property investors buying in Victoria, as distinct from every other state. And pre-land tax, it was sitting at around about 16%. That's probably where we saw obviously we know with Victoria, if all the markets were kind of doing this, Victoria was kind of going flat. Long-term average is about 16% of our investors were buying there. When land tax happened, that basically dropped 10% overnight. So it was single-digit investment in Victoria, and now it's back to number one at 32% of investors buying in Victoria. And for anyone that is transacting in Victoria, they know, right? What's interesting is that we're not necessarily seeing it in the totality data. And one particular reason for that could be the purchase prices. The average amount that property investors are spending on an investment property is about $650K, which is below the median for Melbourne. So if we're seeing a flurry of transactions at that point, then that's actually likely to drag the median down. And it's really interesting to see, and this is maybe something that's more of an observation that I think will drive the property market in the next 12 months. Really interesting to see the 5% first home buyer guarantee deposits, the caps for every capital city. It's slightly below the median in every single case. And I have a theory as to why they've done that.
Yeah, and Heather, I wanted to get your perspective as a money or an accountant as well, and maybe even Mike as well. are you sort of seeing, because I mean, I suppose you focus on the investment, but there is the owner occupied. So anecdotally, you could probably speak to this as well, Mike. I want to know, are people sort of weighing up, if they don't have an investment property, are they sort of saying, okay, great, I've got this potential opportunity to get into a property that's maybe $1 million in Sydney, or I believe 950,000. I mean, it's a little bit more, 1.5 million in New South Wales, or Sydney, sorry, not 1.5. And then Brisbane, I think, is about just over $1 million, 1.05. I could be wrong, give or take. Are people then weighing up, okay, great, I could buy a property for $1 million with $50,000, provided I've got the serviceability, or I could go and buy an investment. What do you think about that, Heather? What are you seeing in that space?
Oh, I was about to say the same thing. It's about the serviceability. So these people generally haven't been able to save the $50,000, $100,000 deposit. The chances of them being able to afford the repayments on a loan that is $1 million. So it's a really interesting thing to see, and it makes me wonder: are they looking, hoping that parents are going to be doing a little bit of generational transfer early, because yes, there's an opportunity, and now my child can get into the property market, because otherwise I don't see the affordability still being there for most people. That's what I'm seeing anyway.
And Mike, what are you? I'm sure you'll have some sort of tracker out there. Maybe it's too soon, perhaps like 4 weeks after, roughly about. Are you going to collect much data on that sort of side of things as to what impact it's had on property investment, or not really?
I mean, we will get whatever data that we can. I mean, right at the moment, it's anecdotal data. So I was chatting to the president of REBA a couple of weeks ago, and I think the Brisbane cap's actually 950, and she was basically saying that everything Melinda Jennison, everything sub 950 within the first couple of weeks, within the first month, there's about a 50% price increase in that sub 950 barrier because of that price point. I mean, it's crazy. And I suppose you've only got to really sort of think of the numbers. And it's not just the first home buyers taking advantage of this. It's investors kind of seeing the writing on the wall as to what happens with the market. But we know that this first home buyer stimulus is it's uncapped, which is quite an unusual thing. In the past, we normally had about 40,000 places. Maybe you could add another 10 to that if it was new builds. But we've got around about, depending on the year, 134,000 first home buyer transactions a year. So we've now got so many more people that might potentially take advantage of this. Heather raises a really good point on affordability. I mean, if you can't save a 5% deposit, I mean, you've still got to save for the stamp duty, but I'm a little bit concerned for people that are flying that close to the sun, just chasing that dream of property. But we know that investors, I mean, the conversations were happening on Ozprop, right? Like this has been brought forward to October, that everything's going to go crazy. And we can just tell the competition is fierce anywhere up to those caps, which are very interestingly just below the median, because the government does not want the press to say property prices soar because of first home buyer stimulus. So if these transactions are having sub-median, then they shouldn't be pushing that price up in real terms. But with the RBA's own modelling, they basically say property prices are increased by roughly the equivalent of the stimulus put in place. So if we give first home buyers 50 grand, then property prices go up by 50 grand, So it's that perennial sort of band-aid fix that politicians are looking at. And I think it's great. We do want to help first home buyers to get into the market. But if you're not one of those people that's ready to take advantage of this, property's just gotten more expensive, ready for when you are.
Yes, absolutely. Yep. That's so we priced it into, we've got a couple of flips in the round under 600,000 almost ready to go. And when we were trying to figure out, what are we going to price this at? And we saw that was brought forward. We all of a sudden went, oh, hang on a minute. Like if we hang on to it even a little bit longer, we might end up with a higher price. But what we decided was no, we're still going to sell according to our original plan. But we're actually doing the calculations going, who can afford this? And now we know that there will be a little bit more demand for it than maybe before, because people are looking at it going, everything just went up 50,000. I better get in now. So yeah, it's quite interesting, how it works in everybody's perspective. But I am very concerned about property affordability, and I don't think that this was a great idea. Might have been a little bit vocal on my own pages about it. I rarely get on and do a video, but that one drew a video out of me going, nope, I'm kind of not okay with it.
Oh, here we go. It's like Joe with his off the plan and his soapbox. If there's ever a soapbox that you want to get, if you want to get Joe in a box that's full of soap, it is talking about off the plan or house and lands, which it kind of just gets me a little bit. I think about, I'm like a little kid. I start sort of giggling a little bit inside when I just see him getting rolled up. Anyway, so Mike, we've sort of unveiled that one of the locations, despite there's a lot of people selling in Victoria, there is also people, or Melbourne, I suppose, there is also a lot of people starting to be interested or buying, looking to transact in Melbourne as well. And we sort of said that Brisbane's starting to sort of lose a bit of its luster. But interestingly, I'm just seeing people are still somewhat interested in Brisbane, Yes, there's, of course, and there's Geelong. But the one sort of poster child last time that you were on, which is last time you were formally on in that thing, was around sort of the start of 2024, which was, we spoke about Perth. So Perth has really come off the boil a little bit, but that's interesting, isn't it?
Yes. Yeah. And I think I'll see if I can find the exact percentage of what Perth is on from our data at the moment. But yeah, we saw well, it's actually not in the top three. So Victoria at 32%, Queensland 31%, and New South Wales coming back in at 18%, whereas Perth was number one for quite some time. When it comes to SA3 locations in our data for the 24-25 year, Townsville was number one as an SA3 location. And I think on an SA3 basis, it basically topped the nation for growth as well. So it just goes to show that people that work with us are obviously very clever and handsome and wonderful. No, I don't, that has nothing to do with me, but it makes me happy, right? Like, I want investors to win. I want investors to purchase in markets that are going to do the things that they invested in property in the first place for, which was to financially change their future, whatever their hopes and dreams are. If they are investing in property, it's because they're aspirational and they're getting off their backside and they're doing something and they're being diligent and they're saving and they're trying to remove themselves from the age pension, which is actually a very good thing for the economy. And outside of that, we're providing housing. We need really 3 million dwellings, and the government doesn't provide the social housing stock anymore. So, when people sort of say, oh, housing shouldn't be an investment class, I said, well, we can have that debate when we have an alternative. We really don't have an alternative. And when we whinge on about negative gearing costing the economy $3 billion. Well, if we had to buy 3 million dwellings to house tenants, it would be about $2.4 trillion. So I think that's the best deal the government is ever going to get.
Geez, wow.
Yes, I actually noticed that in some of the early figures that you gave us, none of it lines up to the headlines of greedy landlords.
Yeah.
None of it is.
Yeah, and that's part of the problem, and I think that's why investors have exited the market in the last little while, is because they're just kind of fed up for being demonized, and we've reached this point where it's hard to argue that investors have less control over their assets than they did 10 years ago. I had a friend sort of equate it to a rental car lease. If you rent a car and it's due back on Tuesday, you don't ring up and sort of say, oh, I was thinking I might just bring it back Tuesday and I want to put some new wheels on it. Like, it's a contract and there are terms, but the government, I suppose, at the state level has sought to offer these protections to tenants, and tenants deserve the protections. They deserve a safe and comfortable environment. They want some certainty, but I do feel like the balance has gone a little bit skew-if.
Yeah. Well, interestingly, there was some. I I can't comment too. I'm not intimately familiar with WA in terms of the perf and what. But in terms of the rental legislations of what's going on over there, it seems as if they're sort of not pushing through a lot of the stuff that is coming through in other states. Now, if you're a property manager watching in WA, please correct me there. But that's the vibe that I'm getting, that despite the colour of the government over there, which is Labor and a red, maybe that's because WA kind of marches to the beat of its own drum to some extent. Whether it's Liberal, Labor, they still have that. So it's just interesting to get that sentiment. And what I was going to say, Mike, you shared that the SA3, the top one for 24-25 was Darwin. That was the PIPA. Sorry, not Darwin. Townsville. Sorry.
Townsville. Careful.
Do you have your top 3 or top 5 of that, or is that you at liberty to share that, Mike? Because I'm curious now. What came in sort of silver and bronze?
I don't have that to hand, but I would assume it would be an SA3 location in Perth, behind Townsville, and things have actually kind of changed quite a bit in the last 6 months. I mean, there wasn't that much activity happening in Darwin. We're starting to see that happen in our data. Victoria, that's a relatively recent entry, and I think the property investment market has really, really changed. I kind of thought.
Sorry, that was when you were going on about the whole like providing for their futures and the pensions.
Yeah,
but Kelly.
It was.
Kelly G.
Awesome.
Yeah. Yep. Go on.
Yeah, well, I mean, you normally describe that as my soapbox moment, Jeff. So I'm glad that you're a bit more complimentary this time. But I feel like the property investment market has changed since Perth. It's the Perthification of property investing. Because there were people that were either involved and did well, or they were on the sidelines wishing that they weren't on the sidelines. And I feel like investors have become a lot less patient. It's like, oh, well, I want a property that's going to do 20% growth in the next 12 months, or I'm not playing, And so that I feel has led to people investing in markets that we would traditionally call quite speculative. Like Darwin has never really been, that much of an investment hotspot. Maybe there's some blips around, 2009 and those sorts of things, but people they're really, really chasing those aggressive growing markets. And that's giving rise to some of these strategies of, we're getting in, here's our entry point, here's our intended exit point, and then we're selling and we're looking for an area that maybe is going to do another 20%, or maybe is a little bit more conservative and has better long-term fundamentals.
Yeah. How do you feel about that sort of, and maybe a tough question, Heather, how do you feel about that, where you're kind of getting in with a particular point to, I know you do flipping, but if I was to buy and hold for a little bit and then sell, how do you think about that sort of almost the really extreme hotspotting, I would call it?
I mean, yeah, it's great if you can get in, but I've seen people lose a lot of money. I've seen people also sit with dud properties that, they had to have. Like, I saw FOMO hit. I've been on the Gold Coast a really long time, and we get the cycles here. And I've watched it since the early 2000s when I moved here. And then I'm also very familiar with Sydney. So they're the markets that I watch a lot. And you see it happen. You kind of get these cycles, and people get the FOMO, and they've got to have the property, and they stretch themselves to get it, and then all of a sudden they're sitting with it for a long period of time. So it's, you can try and hotspot a market, but you only need. I was trying to think of a really simple way to explain it to a client, and I said, look, you only need 5 properties to make a significant difference in your life. 10 properties, and you will make a significant difference in the life of future generations. So why risk it when all you need is 5 to 10 good properties? Go and find that quality property. Spend the time, spend the energy and the effort, rather than just, like going and taking a giant risk like that. So you can tell I'm a little bit more risk averse, but that's how I feel about it.
I think that's sterling advice, because there's many people that haven't really seen a downturn. And, you know, you talk about markets like Perth and Darwin. These are markets that have had decade-long flat plateaus of zero growth. And back to your point, Jeff, in our survey, Western Australia was ranked the most pro-investment state, followed by Queensland, and then Victoria was rated the least accommodating. And, you know, that's the reason why we now have 10,000 less rental properties in Victoria. It's not just the land tax. It's the Residential Tenancies Act. It's the minimum standards and a million different things. And, you know, the Victorian economy is a little bit of a basket case at the moment. So it's not without its risks, but I think sometimes people just think about property like it's a clock, and that the gap between 3 o'clock and 6 o'clock is the same as 6 o'clock and 9 o'clock. The downturns, the upswings, they aren't these uniform things. It doesn't have a 6-month downswing and a 6-month upswing. I mean, it could have a 5-year downswing and then maybe a 1-year upswing. I think sometimes, you know, looking at those little gimmicky things can be a little bit misleading.
And I sort of see, and I'm not intimately tracking these markets, so I should put a caveat and disclaimer against every comment that I make about them on a forum. But at the same time, I looked at a little bit. We're talking markets like your Townsville, like your Rockhampton, your Bundabergs, your regional Queensland, and I want to unpack what the disparity in your data look like there as well, Mike. But I just sort of say you really want to look at these markets over the 20 to 30 years. I'm not saying necessarily investing for that long. If you want to, fantastic. But you want to see, okay, great, what was Townsville doing in 2011, 2012? And what did it do in 2019? Similar story probably to Rockhampton, Bundaberg, Darwin, all these places. And just say, well, okay, it's seen Darwin's probably not quite at that Townsville level yet. But if it kind of goes, if it follows, and history doesn't repeat, of course, so maybe it might not. But if it did do that, what does that mean for your property investing? Does that leave you stuck? Does that leave you in a situation where you're living hand to mouth? So what does that mean for you? Because don't assume it's going to keep going, because what happens when there's a little bit of sentiment loss and investors move on to the next hotspot? And if you're the one left, maybe holding the bag. So just keep that in mind. But Mike, what I want to know, regional versus kind of metro, because there was a little, like, what fared better, at least in the investment data that you sort of, where are people kind of looking at?
In terms of our own data, I think it's really driven by those affordable markets, right? So when we're talking about an average purchase price of 650K, it begs the question, well, where are you going to purchase or transact at those price points? And I suppose at the beginning of 2023, you were going to places like Adelaide, you're going to places like Perth, and to some extent Brisbane. But now it's like, well, that's not really available anymore. So it does kind of force people to go to those regional areas. And, you know, Queensland's a very different place to Western Australia. One big difference is that around about 75% of the West Australian population lives in Perth, whereas you look at Queensland, it's a bloody big state with quite a few cities along the coast. So when we talk about, oh, you know, Queensland, it's growing, it's like, well, that's a bloody big state, and that's a bloody big statement, right? So there's been plenty of markets outside of Brisbane in Queensland that have done really well, like Townsville, and, you know, Toowoomba's another example of that as well. So
Ipswich,
yeah, look, I think interest in regions is really just driven from price points. And I think we're kind of seeing that in Bendigo and Ballarat as well, which is a little bit cheaper in Melbourne. And from what I'm hearing from people on the ground, it's fever pitch there. And the competition at those lower price points is crazy. People are almost certainly overpaying for what at that point in time should be the value of that asset, but they have so much confidence that it's going to continue keep going. They're sort of placing that bet to say, okay, well, if I overpay by 10 grand, but it grows by 100 grand in the next 12 months, fine.
Interesting.
But it's a risk.
Yeah. And I'll throw this to Heather, because you may, I know you're Gold Coast a little bit, but I want to hear your thoughts on Buval and in Ipswich. We're not saying that you, of course you have to, this is an investor who's asked this, because I think they're two markets that have performed very well. Mike, what are you seeing about I mean, regional South Australia, Paralowie is not regional South Australia. That's Adelaide. But Burton maybe is a little bit further up, of north of Adelaide. These are is regional. So yes, Ipswich is regional Queensland, regional Brisbane. But what are you seeing in terms of Adelaide, Mike? Are you getting much investor activity down that way in terms of your reports, or is that sort of coming off the boil quite a bit?
Yeah, I think it's definitely, peak of the market, and it's still kind of humming away a little bit, but it got smashed pretty hard and fast. And I really kind of think 2013 and 14, and to some extent 15, it was really the three markets that were driving all of the national growth in Brisbane, Adelaide, and Perth. So yeah, I mean, Adelaide, it's an interesting case. I mean, I'm not a hot spotter. I don't spend my time analyzing these markets. I mean, I have my own curious interests, and I like looking at the data. So we are just really reporting where people are going. But we're seeing Victoria be way more popular than South Australia. I mean, South Australia is not in the top 3 states for our investors.
Yeah. And Heather, I'll throw to you. I know it's a little bit outside of your mandate, being the Gold Coast, but do you sort of see or hear much about on the ground of what's happening in Ipswich? Because there is still a lot of interest there, but are you sort of seeing your investors and people you're conversing with, what are they seeing in Ipswich, or what are you doing out that way?
So the great thing about Ipswich is that it was outside the Brisbane city, but you can still drive a reasonable distance into work if you're in the CBD, or you can get public transport to the CBD. So Ipswich is one of those outskirt of a city towns, and it, for a very long period of time, was low socio-economic, and the housing was similar. And so there was opportunity there, a lot of opportunity, and it still continues to have a mix in that social scheme. But as people have gone into those markets, obviously then that changes the social mix in those areas. So yes, I think there is still good properties in Ipswich. It surprises me when I look at Ipswich as how much it has grown since I first started looking at Ipswich 10 years ago. It is significant. But yeah, still a lot of opportunity for especially flips and things like that. Booville, I think, where is Booville? Is that over near the entertainment centre? I've got a feeling that's, I don't really know that side of town so much.
There's a little bit of flooding issue in Ipswich, so there is a perception that half of Ipswich floods. So just be mindful of that when anybody's buying there. And look, there's a really small amount of flooding up in the Paralowie sort of region, having sort of investigated that. But yeah,
Ipswich Council does an amazing flood mapping, and it will actually show you. So you can just jump online. Anyone can look at it. It's public information. Type in the address that you're looking for, and it'll actually tell you what year it flooded. So they've had some significant floods, and it'll tell you, yes, it got hit in the 2017 flood, but no, not in the 2010 flood. And you can kind of get an understanding from that as to how serious the flooding is. And then probably just also keep in mind that the way that the insurance works around there is, even if your house didn't flood, and again, not advice, but even if your house didn't flood, but the flood hit your boundary line, you will be classified as flood. So, try and understand what the difference is there too, can be the difference in the value of a property.
Yeah, it's interesting. So, Mike, I'm going to throw a question from Gurav. You should get him on Geared for Growth as well if you haven't already. Interesting fellow for sure. He said, "What are investors switching onto?" You probably don't have that data, but do you have any sort of inclination as to where are people sort of then sitting in cash? Are they moving across to other growth assets, or that's a bit beyond the scope, is it? Or
yeah, I mean, for the investors selling, there wasn't necessarily a premise that they're taking that money and investing it into any other asset class. It wasn't part of the questionnaire as such. So I think the majority of the investors that were selling are probably fed up with the constant changes and the landlord bashing sentiment. But many of them are transitioning through a different stage of life. Maybe a bit of debt consolidation. So I mean, where they're parking the money, where's the smart money? I mean, that's a really good question. I was chatting to someone earlier today who said they've got a self-managed super fund set up. You know, they've got a bit of a diminished budget, and they're kind of wondering, well, like, I can't just let it sit there. If I don't do property, what else do I do? Do I do gold? Do I do silver? I mean, like, materials have gone through, those precious metals have gone through the roof.
Did you see the lineups outside of the mints in Sydney? I think it was, or various mints around the country. And I just think that, to me, is I don't. I mean, not that I'm saying people should or shouldn't buy these assets, but I'm not particularly because I just haven't really gotten all that excited. And I've got friends who are quite heavily interested in that stuff, and I just think when people start doing that, I think maybe it's like, not say it can't grow more, but yeah, it's just interesting, isn't it, Mike? When your friend at the conference.
Yeah, we're talking like 60% growth in the last little while in gold in particular. Like, it's been crazy. If you look historically, it's not the biggest boom that we've had in gold, but you know, gold is one of those safe haven assets. When we have a period of geopolitical uncertainty, then people go to those kind of safe things. But I don't like gold or silver or anything like that compared to property because of the ability to leverage, and gold doesn't give you a yield. You know, you can't put a tenant in a bar of gold, right? And you know, I
can swap it though for some wheat bix at the thing. How would I devise it though, Mike? That's the challenge. I'd have to buy a lot of boxes of wheat bix with that bar of gold these days.
I don't know how your mind works, Jeff. That's probably a whole another episode, but yeah, I mean, it's been fever pitched and really interesting to observe. And you know, there's a lot of economists that are talking about, given sort of the uncertainty in the globe economically and in terms of tensions, that we can
say Trump. We can say Trump and Xi Jinping.
Trump.
Like, those guys.
The markets are still relatively bullish, and I feel like we're probably going to witness some madness when it comes to the AI side of things as well. I mean, we tend to overestimate the capabilities of things like AI in the short term and underestimate it in the long term. I think we're definitely overestimating it in the short term. But yeah, interesting to see that there's been a lot of job losses from junior employees, like much less than senior employees. There's anecdotal evidence to say, well, it's not kind of reducing workforces broadly speaking, but it's increasing the productivity. But we're also in a productivity crisis. I mean, the AI revolution, it was touted as 30x the industrial revolution in terms of impact. We haven't seen anywhere near that yet, but that'll be an interesting thing to watch. So you know, it's kind of a risky time in the stocks as well.
Yeah, very interesting, very wide ranging. What I'm going to do, I tease people about it. I'm going to give, there'll be one suburb that will actually be up in your neck of the woods, Mike. You're up in Newcastle, sort of, north Sydney way. So you may be able to commentate on what because I'm going to talk about Mayfield, which is on the outskirts of Newcastle. Or where are you?
I went to school there.
Oh, so you were just what happened in Newcastle? What happened in Mayfield? Sorry, Heather. Somebody bought there?
I went to school there.
Oh, you went to school. I didn't. So do you support? I mean, you're probably not a sports supporter, but are you New South? Are you a Blue? No, you're not a Blues or a. Okay, all right. Because I was going to say if you're a Cockroaches fan, which is the Blues. But anyway, so people have requested the Newcastle. And I'm actually very surprised now. So this is hashtag we're looking at here. And I want to get I know you're not a market commentator for property locations, but you probably have some local insight, I'd hope, Mike. If you don't, just blink 3 times and you blinked
No,
once.
I mean, like, I'm just zooming in so I can see what you're showing there. But like, what I think is a challenge for Mayfield is the price point. I mean,
exactly,
a property investor's spending $1 million. I mean, not according to our data. I mean, I'm pretty sure last time I might have been on with Jeremy Yanazelli, who was talking about there's actually some. Yeah, there are some sweet spots, you know, in that kind of $750 to $1.4 million range because nobody's playing there. At the PIPA conference last week, we had Scott O'Neill on a panel, and he was talking about having something like 150 inquiries a week, and 75% of them with a sub $2 million commercial property mark. I think sub 750 is the residential equivalent of that. So like Mayfield has always been quite a rough kind of working class area of Newcastle, but has gentrified quite amazingly in the last little while. And it is kind of I mean, it's on the west side of the city, but it's a very close commute to the main area, and it's been a fairly good performer in the last decade. But that price point is a challenge for property investors.
Okay, can I get out of the full screen? That's the challenge. That's what I need to do. That's going to be my. Okay, maybe if I double click. This is awkward. No, I'm zooming in further. Okay, I'm going to stop sharing my screen. But no, what I was seeing there, and throw some affordable suburbs in, because yes, it's around roughly $1 million, give or take. The thing that I was seeing, so I've figured it out. I'll start sharing again. And interestingly, to Mike's point, is the lack of sales in that particular suburb. So I'll do a bit of a suburb deep dive, or a very shallow dive, I suppose. Yes, the yield is challenging there at 3%, because you imagine if you're an investor, that it's seen, according to HTAG's data, 12% capital growth in the last. So there is a lot of interest in Newcastle, and I see it on the forum. And so what we're looking at here as well, we're seeing you're seeing the population there of that particular location. You've seen over the last 10 years, it's grown more than 100%, close to 130%. So is it reaching, to Mike's point, is it unaffordable for the locals? Like, even the last 3 years, 16% and that's not ridiculous, but 5 years, 60%, which would have caught the COVID sort of situation. So the other thing that's interesting is rents have risen considerably over not the last year, but of course, that's because of COVID. The thing that I would say, so as pointing to Mike, it is a gentrifying area, an ERSAD of 5. So what I'm doing here is pointing to all the things some of the things you should be considering. You should be doing a lot more research. So renter to owner, there seems to be a lot of people renting in that area though, Mike, as well. Is that?
And to be honest, like it's just one data point, and there's reasons why you shouldn't get too obsessed about it. But I typically don't like areas with a high proportion of renters as an investment spot. And the main reason, and we see it in our own data, is that landlords spend less money on their properties through their ownership journey. And we know with our own data, so about between 22 and 25% of property investors actually occupy their property prior to renting it out, which is when we crunched that number, we thought that was way bigger than what we thought it would be. But we know that in terms of the post-purchase renovations, the people that occupy that property spend roughly double than the people that buy that property and just rent it out straight away. So you kind of think about, like, if you're invested in the community and you're living there, you're more likely to improve your home. And if you're doing that and the neighbors are doing that because they're owners rather than landlords that are really trying to treat that property like a business, not maybe overspending to make it beautiful because that's where they live, then that actually kind of, it's like almost an anti-gentrification stat. So that's a pretty high number, like over 40% rental.
Yeah, and the other thing, and I've got a question for you, Heather, as well, because it's by Dean. Dean Zach. I love a bit of Dean commentary. He chats to me occasionally. But the thing I saw there, I did take it down. But the affordability is almost, and look, you need to take, none of these points should be taken in isolation, but it's just forming a view. So for me, your affordability rents. The time to own is getting closer to that sort of 45 to 50 years, which you just sort of start to say it's not really that affordable, probably because as you given us that local insight, Mike, it's your more working class. So and gentrifying and gentrified is probably not the word to use yet, but you're going to need more people to move in that have got that money. So it's almost a ripple effect that you're going to be relying upon probably for that market. Look, the data looks pretty great, which is then reflected in the capital growth it's seen over the last 12 months. But then you kind of need to go a lot deeper and say, well, how does that match back to your strategy, and does that match what you're looking to achieve? And Dean's come up with a great point here, and I want your perspective on this. Where are you guys seeing the better cash flow focused properties with strong fundamentals for growth also? So he wants a bit of cake and he wants to eat it as well.
He wants a unicorn. Isn't that what the forum's about? I want to be anonymous, and I want the best location for capital growth with the best yield. And I want you to tell me free.
Being purchased in that affordable range, let's say up to, so he's looking for what 70 to 80% of Australia are looking for. Sorry, Dean, about giving you a little bit of slack, mate, but I sort of, he's probably okay. So he said regional metro houses or townhouses and apartments, because that's an interesting one. The survey didn't say, did a breakdown whether people are, or do you have any data as whether people are looking at townhouses or houses, Mike? And then I want to go to Heather, see what I'm sure she has a lot of views on this, or some views.
Yeah. Well, it did cast some light on regional versus capital city. So regional Victoria was the most popular at 19.3%. Regional Queensland was next at 13%, and then New South Wales underneath that. So look, regions offering a strong case from that affordability point, right? And we're very unlikely to get a rate cut this year. I think Oxford Economics are saying February they expect it to happen, because they do believe that inflation is, broadly speaking, cooling. This is just a perhaps a short-term sort of thing. So yeah, regions have got some great opportunities from a price point, and I feel like in terms of the capital city to regional kind of cycles, regions are actually kind of pushing up to the sort of higher point of the elasticity of that relationship, where we've kind of found that units have actually kind of split from houses to some degree. So at the REBA conference, Terry Ryder was speaking there, and he was actually very, very bullish on units. But we have to sort of be careful to understand, what are we talking about there? Is that a unit? Is that an apartment? Is it high rise, or is it a walk up? It's most likely not to be high rise apartments, even though it is kind of an interesting thing to observe that these projects aren't stacking like they have been. So the pipeline of high density residential is diminished. So that sort of begs the question, should it see better results? Well, probably yes, but I still wouldn't be touching high-rise apartments myself personally. But it's some of those, 1950s, 60s build where the defects have long been identified, and they're pretty bulletproof things. And if you look at some blue chip locations in places like Brisbane and Sydney, the differential between a unit and a house is massive. It's like half the price. So for people that value those school catchments and those areas, it's an opportunity to purchase in those locations without the huge premium of a house. I think traditionally we've always seen houses outperform units, but every now and then that elasticity kind of stretches, and then we get that sort of coming back a little bit. So both from a price point, units can make sense from an affordability, and also the prospect for growth, I think, is going to be somewhat more positive than we've seen traditionally.
What are your thoughts, Heather? I like your commentary. I saw you nodding quite a lot, so I think you liked that Mike had apartments and units and townhouses.
Definitely, because I am like a stuck record on this. So I'm going to say Gold Coast, always the Gold Coast. That's like my standard answer for everything. I've travelled Australia twice, the whole of Australia, extensively, and it is the most livable, wonderful place there is in all of Australia. And we're a growing boutique city. So we continue to grow, but we also kind of hemmed in, right? So we've got this amazing infrastructure that's continuing to build, but we're limited in our land and how far we can stretch. So to me, that signals continued growth in prices as, supply and demand. So we can only supply so much in the space that we've got. And because it is such a livable place, then your rent is also quite high. So it's, you're not just paying the high prices, but then not getting the rental yield. You're getting the great rental yields as well. And onto what Mike was saying, which I just love, the boutique apartments. Gold Coast is full of them, like the 12 apartment, 1960s, 1970s built. They're around that 800,000 that was asked for. And so, and the townhouses as well, they have both the apartments and the townhouses. And I think that they make a really solid, personally, and, I'm not telling everybody to go out and buy on the Gold Coast. I'll be upset with you all if you do. But yeah, I think the Gold Coast, always the Gold Coast. It's good value.
There you go. There you go. I'm not so Magic Mike looking sharp as always. Brendan, we should get Brendan on the podcast at some stage. Brendan Kroll. I don't know. I think you may have chatted to him at some stage in the DMs, maybe Mike. But I want to hear. So we're gonna throw our first break. I'm doing this a bit later than what I would have liked, but that's okay because we're all having so much fun. So I want to hear, Mike, about what where there's sort of some optimism and where there's, or is there optimism? Like, are people going to buy? Because we spoke about this market reset, and I've got some interesting questions around what is happening in the corporate space, because I imagine you both would probably have some insights there around sort of layoffs, and you just have sort of little snippets and all the ones that mentioned. So Jordan, okay, I'll have to have a look at your so pick one of Jordan Suburbs people as well. But we're going to throw our first sponsor for the evening. See you back soon.
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For OzProp members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policeyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
Oh, Mike, I challenged him and he did not succeed, but that's okay. Steve was causing an absolute ruckus today and saying that property investing is effectively going to be dead in. He's back. I just had to fill in the white space there, Mike. But yeah, Steve was talking about property investing is going to be dead in 10 years, so we might have to save that to another conversation. But this is
a naughty boy, that Steve.
Yeah, I know. And I said, mate, I thought you said you didn't do clickbait, and he's like, oh, but I believe it. I'm like, well, okay. Hey, everyone, really interesting points. I'm curious, do any of you have any insights into what's happening in the corporate world? It seems like a lot of firms are running out of work. Are you seeing anything like that, Mike or Heather? Heather's shaking her head. What are you seeing, Mike? Because unemployment is a little bit, but...
Well, we've seen some big layoffs from Amazon recently, but I feel like that's more about efficiency. I remember reading something, it's maybe 7 or 8 years ago, about the revenue per employee. And to give some context, I don't know if it was David Jones or Grace Brothers, one of those department stores was running at about $200,000 of revenue per employee, whereas at the same time, Amazon was at $1 million of revenue per employee. So that just kind of goes to show the differences in businesses like that. So I feel like that's more representative of them sort of trying to drive the bottom line than a lack of consumption. But, the economy is not exactly soaring along. I mean, technically, we're in a per capita recession without international migration. So I don't have any exact observations about sort of running out of work. I kind of think, we're still relatively low unemployment, even though it's upticked. But really, there's, economists will kind of talk about human capital as kind of there being a sweet spot, a functional unemployment rate that enables, the mobilization of workforces to different industries. And we're probably, it's probably lower than the long-term average. So that kind of says to me that there's still quite a lot of demand. But for more info on that, like you can often look at some of the data that comes from the job hunting sites like Seek. They publish heaps of really good data on that, and that might add a little bit of flavor to that question.
Yeah. What are you seeing? What are you seeing on that space, Heather? You've already shook your head. So are you saying not at all?
I'm not seeing it, but I know that people are feeling it. People are all asking the questions. So what's happening in the next 5 years? We're all hearing that billions of jobs are going to be lost to AI, and people want to know, like, where does that leave us? How do we pay our mortgage? How do we eat? What is happening? So people are very interested to know. There's a lot of talk around the financial reset, and people want to know, is this true? Is this coming? The property bubbles. So I'm not seeing anything like specifically from the corporate world myself, but hearing a lot of people going, okay, there's all the things happening around these worlds, and we want to know what's happening and how it's going to impact our everyday life.
Yeah, interesting commentary there. What a kind of a watch this space sort of thing. I think it'll sort of bubble along, and then maybe it could turn into the year 2000 thing where we thought that everything was all the computers. I remember that there was hyperbole about everything's just going to crash because it can't handle these extra zeros in this thing. They're ticking over the millennium, and we woke up on the first of. Well, I woke up on the 1st of January of 2000, and the sun still rose. Things were okay, but maybe the singular. When will I get uploaded to the singularities? Oh no, that's a different question. I'm probably butchering that, so sorry for my analogy. But Mike, speaking of sort of transitions and changing, what's happening with why? We've spoken about why investors are selling, so it's government sort of thing. It's part of the natural cycle, but have we seen, I wanted to sort of, this is a broader philosophical question, is property going to be less lucrative going forward? Is that kind of what we're seeing, you think?
Well, I mean, I'm sort of reminded by statements throughout history, things like the median house price in Sydney will never be over $1 million because people just won't be able to mentally get their head around it, or that the income to asset price will never go above 10x because, where is the money coming from? Yet those things have been destroyed. I think what's missed from a nuance in the argument is that the world is a little bit different to what it was in the 1970s, and you can go back to the 20s and 30s and read newspaper columns talking about housing being unaffordable, and it might have been unaffordable back then when they had 7-year loan terms and there was only one person generating income. We now typically have 2 people generating income. We don't have 7 or 9 year loans. We have 25 and 30 year terms, and we also
even
have
40 coming up as well.
And I think that is probably what we're likely to see. I don't think the government is going to oversee a crash in first home buyer activity. That's obviously something that they're interested in. And rather than Steve's dire prediction come through, I think that they would rather actually just basically take investors out of the market than see that happen. But it is concerning for people, and like I have children that I hope to will own a property one day, and you kind of wonder, like, okay, well, what's the median house price going to be? Maybe it's $20 million, and it'll be fine if they're on like $1 million a year. But that's where the kind of the future of work and the AI stuff comes in.
Yeah, geez, wow, that's we could all even have a podcast on that. Like Steve wants to go there with this whole philosophical thing. He's off drinking his almond cappuccino or whatever. But yeah, I could. I'm sure Heather. Poor Steve. How do you see? I know this is a big question, and maybe not a question for anybody here. But I'll throw it out there anyway. How do you see commercial property performing? Because I'll get Heather's and also Mike's, especially office space with places like Victoria mandating work from home policy. Is Victoria, have they actually mandated that? Or are they? I thought that was in the works, but are they mandating that? I didn't think that. I think they
might be referencing the recent case from the Westpac employee that went through to arbitration, and they basically awarded in her favour to be able to kind of work from home. I don't think Victoria's mandated anything specifically. I think it's normally via negotiation before it goes to like a fair work sort of thing. But sorry to I think I jumped on your spot, Heather, but I just had an idea in my head. I was at the Real Estate Institute of New South Wales Commercial Property Summit today. So people that are far more connected to that space, I wasn't there the whole day. I came in to present about the stupid tax stuff that I talk about. But I was hearing from a few different people, and when it comes to office space, it's the A grade stuff is performing pretty well, but it's the B grade and the C grade stuff that is really sticking around, and people aren't wanting to spend money on these fit outs. So from commercial property, it's the things that are kind of have a multi-application that are a little bit more popular, like things like the industrial and the warehouses and those sorts of things. So, think about the nature of work at the moment, the nature of consumption. Logistics is a big thing. Data centers. I mean, there's been huge investment in data centers in anticipation from this AI boom. And, what is the constraint to AI? It's token limits, right? For anyone that works with AI or is trying to build AI agents, there's a certain amount of data that you can send to a model and get that back. And I think that it will be the area that we see in expansion. And that's just going to require more and more processing power and more data centers. So those well-located areas where they can get the electricity load and they've got the services there will be popular. I think like post-COVID, Simon Presley was talking about like CBDs looking like an egg. You crack an egg into a pan, there's the yolk, that's the CBD, and then there's the white sort of ring around there. And that's the traditional model. We have the central business district. But post-COVID with working from home became more like a scrambled egg model. So we don't necessarily see those big hubs. So the commercial properties that are doing well in some of those trickier sectors like retail are more those neighborhood community centers than the big, landmark retail centers. So, that was kind of the takeaways from that conference today.
So commercial property will still be around. Office space, maybe, give or take. But that's the TLDR. But I love your passion though, Mike. And people are starting asking about AI. If you have any AI experts, we may need to get somebody on AI and property. But Heather, commercial property on the Gold Coast. Like somebody did ask about because Steve is a little bit excited about that, but what are you kind of seeing up there in the commercial space? Like I know you're not a commercial so-called expert, but what do you think? What do you see?
Not by any stretch, but something Steve said at the session in Sydney, the live, which fascinated me and rings true now that I've reflected on it and thought about it, is he said that it's not true what you hear, in social media. Who would have thought? That, we were under the understanding that commercial property, the value of it only rises when your lease, based on your lease value. So if your lease doesn't improve significantly over, let's say you've got 10-year leases in place, don't expect any sort of rise like the residential market. But Steve said that's actually not entirely true. It does rise. It just rises in a lag. And we do see that. We have seen that on the Gold Coast, and we do know people making money in commercial property on the Gold Coast. And so, it's interesting. I don't see a huge amount for lease signs for very long. And if I did see them, it's probably around what Mike was just describing, those smaller stores. Maybe even there seems to be small pockets around the Gold Coast that churn over tenancies. I think maybe just more the foot traffic type tenancies, small offices, maybe accounting firms, things like that. And they don't seem to be able to get those longer tenancies in there. We haven't had, so there was up the road from us is something called Carrara Village that was empty for so many years. And it used to have cocoa fruit market there, and it was where everybody wanted to go. And then all of a sudden it was vacant, and it stayed vacant for many years. But I've just noticed that all of that's leased now. They did a bit of a refresh. It's all leased. And I think that, there's definitely that, the small drive-in kind of commercial retail. There's definitely great value in that. People like to be able to drive in, get their fruit and veg and or whatever services they want, chemist, and then keep going without having to necessarily stop in a big shopping centre. I don't see the shopping centres have vacancies like in other places that I've lived or travelled and visited. So that's I mean, that's what I'm seeing on the ground. Again, no expert, but
No. Thanks for sharing. And Mike, be prepared. There is a depreciation question, but you may not like it.
Oh gosh.
Yeah. Poor Mike. No. It'll be good and it'll be fine. So I've set
I
you
can
up.
take it.
So
I can
it's
take
almost the Chris Voss, like that sort of I don't know what tactic they use, but it's like you're negotiating in terms of you're setting people's expectations sort of, and then you're like, oh, that wasn't so bad. But yeah, Toddy loves Chris Voss. But anyway, so we will talk about, I want to know, well, what people's expectations are for property investing, and are they optimistic about buying? We've spoke about it a little bit, but I want to sort of round out the conversation. I think that's really, we've spoken about a lot of areas. We've spoken about SA freeze. I've got one little part that people wanted another area. Joe hates it when I talk about Geelong, but that's okay. We can talk about Geelong, people. He's not here. But before we do that, we'll throw to our second and final sponsor. So for anybody, stay tuned, of course. But for the guests, you may be able to take a quick break, and we'll see you back very soon.
Everywhere you look, someone else is making money in property except for you. Your mate, he just bought a house. It's already gone up $100,000. There's some bloke on Facebook, he's bragging about pulling in a 7% rental yield. Meanwhile, you're stuck scrolling real estate and domain, confused as hell, and having no idea about where to start. Or maybe you're that mate that's got $100,000 in equity. You have a few properties under your belt, but you feel stuck. You're unsure about how to scale without over-leveraging and not knowing what the next right move is. So why does it feel like everyone else has some kind of secret that you're missing out on? It's because they do. There's a reason some people keep stacking properties while others sit on the sidelines stacking excuses. There's a reason why some investors buy under market value while others pay too much. There's a reason why investors know the hot spots before there's any heat. And there's a reason that some people build $150,000 in passive income while others just spend years thinking about it. And it comes down to knowledge. And that's exactly why Jeff Miles and I, Joe Tucker, created the Level Up Property course to hand you the exact step-by-step process that we've used to buy over $100 million worth of property in today's market. We've built Australia's largest property investment community with over 80,000 members, and we help everyday investors secure hundreds of thousands of dollars in equity, all without wasting years of their life trying to figure it out the hard way. Making an uneducated decision on the biggest purchase in your life is just gambling with your future.
Stop it. Get some help.
And this isn't just another how to buy property course. Let's be clear though, this course isn't free. What? And neither should it be. This is our life's work. We've spent over 100 hours each on this course alone. Oh, babe. Okay, video number 3. Number 4 with million does... Fuck. Done. We've got decades of experience, millions of dollars in deals distilled into a repeatable process that you can take away for yourself. If you're looking for free advice, there's plenty of noise out there. You can go and find that if you'd like. But if you want real, actionable, step-by-step guided process that works in today's market, then this investment is going to change everything for you. By the time that you finish this course, you will have full confidence. You'll have every tool that you need to build an amazing portfolio if you act on it, right? Which is why we have mentoring built in. So we kick you up the butt to make sure that you're kicking your goals. So the real question is, how much longer are you going to watch everyone else making money in property before you jump in and start playing the property game properly? Because the sooner you start winning.
We are back. That's I feel for the person that had to collaborate and listen. We should. No, I'm not going to go and rap on. I just try.
I love those ads. They're so good. Yeah.
But so Mike, we've got a couple of. Yeah, I like when you do this. It's like I've given Mike. I want to know, what is the proportion of investors that are looking to likely, what does the future hold for property investment in 2026? Like, what intention and optimism is there in the market and percentages? We've got some data there to share, and you shared it, but bring it up.
Yeah, from the PIPA survey, there's a lot of optimism, I think. So nearly 60% of investors believe the next 12 months is a good time to buy residential property. And that's a big jump up from 45.7 in 2024 and close to the highest we've seen at 62% in 2021. And that's when interest rates were at record lows. And, people are doing that now. 28% of people have purchased property in the last year. So it's a bit of a turning point. So I think people are quite optimistic, and that's mostly pointed at Melbourne right now. 41% of investors see Melbourne as the best place to buy right now, and that's jumped from 26% last year. And so after that, they're talking sort of Brisbane and Perth, but yeah, Melbourne's definitely getting a lot of optimism. The top reasons why people said it's a good time to buy is good long-term capital growth prospects, 70% of people, population growth, 59% of people, major city capital appeal, 52%, high demand, tight supply at 42%, and 35% the housing shortage. And that's something I've got some sort of data on that I think is perhaps bad news for society, but good news for property investors. And there's the supply side is not coming on in the way that that the policymakers or politicians had hoped.
Jeez. Yeah, it's interesting that sort of the thing I would say about Melbourne is, and Victoria in general, is you have to be really onto it with your due diligence if you're doing it yourself, if you're using it, because you've got minimum standards issues, you've got challenges with contracts. If you're not to throw some water on the Victorian fire, actually that's funny, Victorian fire, not funny, I'm sorry. But yeah, you sort of, then you've got, okay, if you to exit a contract for pest and building, typically it has to be structural, my understanding. Of course, speak to your conveyancers, all that. So there's those potential gotchas you just need to be really careful of. But it seems that it's not necessarily deterring people. Yes, there's land tax as well. I saw somebody today in a comment saying they're paying $80,000 in land tax. I was like, oh, okay. I mean, yes, they may have inherited it, which means that they may not be as wealthy as it may just be inherited, which then creates a challenge. But yeah, Heather, what are you kind of in your sort of circles, your I suppose coaching and accounting, are you seeing people still interested in property invested anecdotally for 2026 and beyond, or is it
definitely yes, everybody's interested. Most people are feeling a little bit concerned, have we left it too late? So a little bit like I was talking about before, have we left it too late? They realize that they're not going to get those big growth figures, and then they're a little bit concerned, around affordability. So it's all of that. And the conversation I'm having at the moment is, strategy stacking is putting together a couple of strategies to be able to afford it sooner, making sure that you are paying down that debt, which is something I noticed in that PIPA survey, is that I think it was it number one, Mike, that people wanted to reduce debt is the reason why those investors were selling.
Yes, yeah, reasons for selling,
yeah. And so that's what people are nervous, they're feeling like, oh, I'm going to be getting into big debt now. And we are talking big numbers for these properties. Those cheap properties, they're so hard to find now, they really don't exist anymore.
Yeah. Interesting. Yeah, it's as to where we're sort of going. But Mike, onto an unrelated topic. I warned you about this, so don't shoot the messenger, please. Magic Mike. So I'm trying to think what I think that's what I usually call you. This isn't a jab, but do you think ChatGPT can be used to generate a property quantity surveying report? I promise it's not a plant. This is a genuine comment. I believe a well-known pod is reporting the ability for ChatGPT to do accurate quantity survey reports. Sorry for educating you there, Mike.
Well-known pod is, and I wonder who the independent expert is saying that it's their quality.
I don't know either. I listen to so many podcasts. I was trying to think because I haven't heard one on that recently. So
yeah,
surely.
Look, The answer is no, and it's also in breach of the Tax Practitioners Board and the ATO guidelines and the Australian Institute of Quantity Surveyors to even let it loose on that. I mean, the biggest problem is that there are very few circumstances where a tax depreciation schedule can be completed without a physical inspection. So ChatGPT ain't got legs is one problem with it. But I mean, I use ChatGPT every single day for a variety of different things. And I mean, in many respects, it's a text in, text out calculator. It is not a reasoning thing. Even if it could have legs, could it identify the fact that this property had been extended or improved? You know, is it contacting the local council to say, look, can you tell me when the occupancy certificate is for this? Because that data doesn't exist online. So there's lots of thought experiments about what AI can do, and it would take a significant amount of investment in that space, and the market's not that big. You know, there's been very few entrances from the private equity space into the quantity surveying field, and far less into the tax depreciation side of things. But really, you need to physically go and inspect it, and I use ChatGPT to crunch our data, and I see all of the mistakes, and I inform it things, and I teach it things, and it comes back with errant problems. So if the goal is to try and save money and cut corners, I mean, it's a dangerous thing to do. You know,
What about Gemini, Mike? I mean, I'm not saying Gemini can produce it, but I think I've started using Gemini now as well, rather than ChatGPT. I'm not saying Gemini can produce the quantity surveying reports, but I'm just saying, do we need to adopt anyway? That's a completely separate.
Well, let me throw something back at you. Let's just say that all the data is there and it's available. We're already out of date. So for example, within our business, we don't just do tax depreciation. I mean, that's just what I talk about because I stay in my little box and that's my specialty. But we work with construction projects in the feasibility stage and as they're coming out of the ground. So we have live construction data from tenders, from subbies that are putting forward these packages of works for these things. That data doesn't exist on the internet. There's no large language model that can access that and scrape that and interpret that and go, okay, well, under this particular area, they've called it joinery, but they've put it in another category in cabinetry for something else. Like
not the virtual peephole.
Yeah, and there's no digital peepholes. And there's so many better applications for it, and you know, it's a current breach of the legislation at the moment. So no, I can't see it happening in the short term. What it might be able to do quite well is to look at plans and do takeoffs, do measures from the plans. But I mean, we're talking about these are big biscuit decisions, so I think it's kind of silly.
Sorry, Mike. I knew there was it was like a red flag at a bull. I couldn't. I thought it was a little bit cheeky of me. Elijah has come to Mike's defense. Can give you a very good desktop, but not a fully due diligence quantity surveyor. So he's
and think about. Think about someone like me who has access to a hell of a lot of data around property investment and tax depreciation. So for example, I've run an experiment with ChatGPT and I've said, okay, when people reach out to us and they say, I want to get a depreciation schedule, here's some information about the property. We have thousands and thousands of line items of those initial inquiries where we get piecemeal information about the property. And then, of course, when we do the report, we actually have real data. We've inspected it. We've crunched the numbers. We can tell you what the total deductions are. We can tell you what the first year deductions are. And if you feed it thousands of instances, it can get pretty close. But sometimes it hallucinates. And it's so eager to please that it will fill in the gaps where gaps are there. So no, stop it, people, please. Don't be doing that. And it's not, you know, I don't, yeah, it's not just because like I'm worried about my job being taken. I suppose we all are. I mean, Sam Altman said like the best thing to do is to become a plumber because we can't do anything with pipes right now. But we're a long way from all of us at the Centrelink queue.
Okay, that was enlightening. I promised another suburb, and Geelong is getting a lot of interest. I'm seeing people I know, and there's on the socials. It's kind of the Melbourne 2.0. But interestingly, the one that people have suggested in Bell Park, which is right next to Bell Post Hill, my understanding, it is. So this, and the thing I would caution people looking at any property data like ChatGPT for depreciation, you need to be cautious of how many sales are actually happening in the thing, because that will potentially skew the data. So you really need to extrapolate and dig a lot deeper. But if we look at Bell Post and the Bell Park, we sort of see that, interestingly, over the last 3 years, is seeing negative 7% growth, and you're sort of starting to see over the last 10 years only 77% growth, which doesn't mean you should be buying this area. Rents are kind of growing a little bit, and I just wanted to point out, yes, URSAT is a little bit low, which may hold it back, which is the socio-economic disadvantage. Renter to owner is reasonable. It's become more affordable, interestingly, as well, in terms of a years to own, which unsurprisingly, given the lack of capital growth it's seen. The other thing that I find interesting, vacancy rates not too bad at 1.68. Days on market has come down. Very low inventory and not a lot of building approvals as well. But noting that it's only 1 or 2 could change things a little bit. But yeah, it's very interesting. Look, the vacancy rates increased a little bit. Inventory is kind of choppy a little bit, but that's sort of, yeah. So I would say that this is unlikely to see 20% growth next year. Look, very unlikely given the trajectory it's heading at. But I know there is, if we look at a neighbouring suburb, you're starting to see those shoots. And interestingly, if we look at the URSAT here, and it could make a liar of me, URSAT is the same. So renter to owner. So vacancy rates very high in Bell Post. So, but I suppose I'd like to sort of see a little bit more on the vacancy rate and sort of seeing what the actual number is. So you're sort of seeing, yes, it's not a high number. So you're going from 5 to 6 is changing things quite a bit. So these are the kind of things you need to consider and dig in when you're looking at data. So look, Geelong is a very interesting market. I won't say too much more because Joe will come out of his hospital bed and hunt me down in Wollongong because, we own in Geelong as well. But no. Mike, before we throw to a last, we're going to have a little bit of predictions for the session. So hope you're okay. I've got my predictions formulated as in the capital cities. Full disclaimer, you've got to do your own thing. But Mike, I want to know what's happening in the depreciation space. Give us a little 30-second to 3-minute. You decide how long you go 3 minutes. What's happening in that space? What can we get?
Well, in some respects, there's a bit of a race to the bottom happening there, and it's a bit of a disappointing to see in an industry that I've been in for a long time and love quite dearly. You'd be hard pressed to find anyone more enthusiastic about tax depreciation than me, probably for good reason. But look, the biggest thing that I'm seeing is that there are quantity surveying firms that are doing depreciation reports without physically visiting the property. And that's just a bad idea for a million different reasons. I'll give you a quick story. At the Accounting Business Expo, someone came up to me a few years ago and said, I got a report on a service station. I said, oh, that's good. They have great deductions. And he said, well, they put a photo on there. And I said, oh, some quantity surveyors do that. Some don't. Like we don't. We can give you photos if you need it. But what they were trying to get at is that the property, that the photo that they had on the report was actually the service station that was demolished for the service station that he purchased as a brand new going concern. So a quantity surveyor did a report on something that doesn't physically exist in the world anymore. And I just find that quite shameful. And the Australian Institute of Quantity Surveyors has been very, very clear. There's really only one way that you can do a report without physically inspecting it. And that's if you build a brand new property, you know the exact construction costs, you have a full detailed set of plans and a schedule of finishes. And I know house and land package people that still insist on getting a physical inspection done anyway, because sometimes it'll say carpet to living areas, and carpet has a way higher depreciation rate than tiles. So is the hallway carpeted? That isn't necessarily on the plans, or it might say stainless steel appliances. Now, is it a Technica appliance or is it a Miele appliance? It makes a big difference. So, that's kind of the battleground at the moment, and it's something that's giving me the shits.
And
Mike.
what is the price difference between a desktop and a physical inspection? Because that could be the reason people are choosing one or the other, or
you're normally talking about $200 or $300 as a difference. I mean, the cost for us to inspect a property is around about $200, and we do that nationally. So, I would love for it to be best practice to not physically go and inspect the whole of Australia, because it's a bloody big place. I mean, we own an obscene amount of Toyota Corollas, and we have inspectors moving around all over the place, going on ferries to certain locations, going to remote areas that have costs, but that's just the right and the best way to do it. So yes, you can save some money, but I've also spent a lot of my career looking at depreciation schedules that are done without inspections and being on site with people where the owner themselves didn't realize that their property had been renovated. And you go and have a look under the house and you can see that the back steps are leading up to the middle of the floor, which is an indication that once upon a time this house was smaller than it was. And it takes a trained eye to be able to understand that. And people are just risking their deductions. If you think about tax deductible things, the interest component on your investment property is probably number one. I would say tax depreciation is often number two, often more valuable than claiming your property management fees, or depending on the property, repairs and maintenance. So I just think, I understand people wanting to save money, but you've got to understand the risks involved in that, and it possibly not being compliant as well.
I love your passion, Mike. You've I've lit a fire in Mike, and the person who asked that question before said, "Thanks, Mike. I was hoping you would unpack it." Oh yeah, go, please go ahead.
Can I ask a question? So, Mike, one of the things that I'm very interested in is building costs at the moment. And just yesterday, somebody said Victorian building costs around 1,800 a square meter, but we got around 3,500 up here on the Gold Coast. What's happening? Is that 1,800 true, or are we waiting?
Yeah, I mean, people talk about square meter rates like it's this perfect uniform way of talking about construction costs, but it depends on a million different things. And I kind of hate professionals going, well, it depends, and throwing a bit of a disclaimer on it. But really, we're not building anything for 1,800 per square meter anymore. I think even when we are looking at project homes, and it's different city to city, we're normally looking upwards from 2,200 per square meter, but it depends on the size, the standard of finish, the site conditions. The availability of trades can factor into those construction costs as well. The good news about construction costs is that we're broadly back to the normal pre-COVID rise in construction costs. So people talk about construction cost rises being the big problem. It's not necessarily the rises right now. It's that 30% increase that we saw over the COVID pandemic that's not coming down. And we have a lot less builders in the country. Like, we saw around about 3,000 insolvencies in the last financial year, and the construction industry is number one for insolvencies. So there's a lot of problems and headwinds, but it's mostly labor rather than materials.
Yeah, there you go.
Yeah, thank you.
I wanted to know. This is our final sort of thing that we'll pop in for the evening, because I think it's been an amazing session, and the viewership has been, we've blown the viewership. We haven't cracked the 100. We got close to 100. So who wants to give the predictions on growth over the next 12 months in Melbourne, Perth, and Brisbane? And when I'm not going to give a percentage number, because that's just too hard. Like, you're making my job too hard if you want me to put a percentage. You guys can put percentage if you want. Surely they're the top three. Let's not talk about Darwin. Why are we not talking about Darwin for? Is that because it doesn't, like, somebody's got to think about Darwin, haven't they? But maybe not.
I can give you a story about Darwin if you want one. It'll take about 2 minutes.
Okay. And then it'll give Mike some time to think about his, and I've got mine because I've been thinking about this for a while. No.
So in 2022, when we were traveling around Australia, I came up with the brilliant idea that midway in our travels is Darwin. We're going to stop in Darwin for about a month. And what we're going to do is we're going to rent an apartment when we're there, maybe a month, maybe 2 months. Get out of the caravan, get out of the tent, and just, enjoy the apartment. Anyway, so we're on our trip, and we're maybe 6 to 8 weeks out. And so we're in the middle of Australia, and already set my mind towards Darwin, thinking I better look at this accommodation, a couple of months out will be necessary. And anyway, every time I did like the booking.com or the Airbnb, it kept coming up that this apartment for the month was going to be $30,000. And I'm like, what is wrong with this? And so I started thinking like, it must be the internet service. There's something wrong with booking.com. So we went, Alice Springs, we did Uluru, we did Kings Canyon. And as we're going closer and closer, we get to Catherine. No, still got this issue with Darwin, 30,000, 37,000. I don't know what's wrong with my booking.com. So I decide that when we get to Darwin, we're just going to stop at the information centre and they will help us out with this apartment we want. We walk in there and she goes, no, darling, that's correct.
It's the dry season. It's dry season.
Dry season, and an apartment is $30,000. And I wasn't we weren't looking for anything fancy. I'm not talking right on the beachfront or right on the esplanade there, like anywhere in Darwin would have done. And it was $30,000 for a self-contained apartment. And so it was at that point I realized that, hey, Darwin let's look at Darwin. Darwin is worth looking at if you're buying in there for the right reason. You understand the seasonality of it. You understand your returns. I wouldn't necessarily just ditch Darwin as a whole. I think there's something there for the right people at the right stage in their investing.
I would have liked it a lot more 12 or 18 months ago, but whereas now it's probably done about 15 to 20% in pockets. Palmerston, for example, yes, there's a lot of investor activity. Wink, wink, nudge, nudge. There's a co-investor, yeah. But anyway, that's fine. But no, I love that story. How good was that? I love the anecdote. So, Mike, I hope that's given you enough time to think through. Are you willing to? You can give us percentages if you want. But where do you think
to two decimal places? Jeff.
3.
No, I mean, so the question is, well, what's going to be better? What, Melbourne? Was it Brisbane, or what was the third one?
Well, I suppose I'm morphing the question to say, where do you see the top 3 performing markets? And this person's thrown Melbourne, Perth, and Brisbane. That's their kind of top 3. Where do you kind of see things landing? I've got a bit of a spicy take in here, but I haven't decided which one. But you go.
Look, to be honest, I think it's kind of the wrong question because you can't invest in the Melbourne, right? And if I answered this question and I said, I think Melbourne's going to outperform the other 2, I may be right or I may be wrong based on what is actually true or what core logic present. So say, for example, if we look at, I know they're bloody called Cotality, right? Melbourne's annual growth rate is now at 1.9%, and it just did 1% for the quarter. Now, for anyone that's transacting in Melbourne, do they really think that it's growing at 1.9%? I'm sure that there were people be saying this market has done 20%, but it's not showing in the data. And if the flurry of transaction values is sub-median, then Melbourne might not post more than 3% next year, but there will be some suburbs that might do 20 to 25%. So that I think is probably more.
Too sensible.
Yeah, well, I'm a bloody quantity surveyor, aren't I? I'm not an OnlyFans creator.
As well, it's your price range.
Yeah.
The price ranges aren't the same, so you can't just give a blanket statement as to what will do well and what won't, except for maybe Brisbane, because it has a very unusual situation, which is the Olympic Games coming up in 2032.
Yes.
So there's a lot of people in their mind.
Yeah. Sorry, Heather.
Carry on.
Yeah. So to me, I kind of think it's more interesting to think, well, what quartile will grow the most? Is it going to be the first quartile price point? Is it going to be the middle, the upgraders, or is it going to be the top end of town? I think there will be probably a fight between the lowest quartile and the middle, as we do sort of see those ripple effects of the people that were maybe homeowners and have seen some of this growth and then moving into those secondary markets. But I love the availability of all of these tech that looks at, building approvals, and it looks at vacancy rates and inventory levels. But these are very short-term metrics, and I think we need to go and think about Yeah, we need to think about the fundamentals. Like the number one driver of property prices for me is the availability of credit, right? So that makes a difference in terms of what people can borrow, and the availability of that funding is going to be the biggest influence. So if we see APRA removing or cutting their serviceability floor, that's going to make a way bigger difference than, tight inventory conditions in a particular suburb. And then it's jobs and affordability. So those markets that have a good kind of metric in terms of household income to asset price will, I think, outperform. And I think we've also got to just look at the jobs. So infrastructure projects, like where are the locations where there are opportunities for people to increase their salary? So those are probably more important things than, looking at some of these short-term metrics. Both for short-term and long-term, those things matter.
There you go. So you're not going to give us free. I'll chuck free out because and I'll caveat this.
I'll give you a wild card, Jeff. I'll let you go, but I'll give you a wild card.
Oh, okay. Here we go. So for mine, I'm going to chuck a little bit of this is one that could. Just because of the amount of activity I'm seeing, it may not come to fruition. But Geelong is a region that I just think is so much. And Joe's going to kick me for this, but anyway. So Brisbane, will be top three. I'll go, one of those regionals like a Geelong. And for my third, it's an interesting one because it's easy to say Perth. So, but I don't know, do I want to be on the thing as saying Perth? I would even sort of chuck another regional in there, like maybe like a Bendigo, Ballarat. Now there's different pockets to Mike's point. So, but I would say there'll be a suburb of there. So it depends on where you're looking and what your budget is. If your budget is 800K plus and you've got a longer term horizon, maybe Melbourne is the place, or maybe Brisbane is the place, and you'll see a little bit of short term growth in Brisbane. But I think two regional, one either. I'd say so. Geelong is a regional, so Geelong a regional, and don't go and do your own research on these areas. And another regional, either Victoria or New South Wales, and then Brisbane. Yeah, but that's me kind of with my shorter term data metric on. So you overlay that with your own. But Heather, what do you think? Gold Coast? Is it Gold Coast or
Gold Coast? Always Gold Coast.
Yeah,
it's just my standard answer, and it's never done me wrong. Never done anything that I've encouraged to anyone who I've encouraged to buy on the Gold Coast wrong either. So I'm just going to stick with it. Gold Coast, always the Gold Coast.
And Brisbane, and probably are you Brisbane? And what's your third? Are you going to keep that one to you? Okay.
Oh, Mike or me? No. I'm okay with Brisbane. But Brisbane's an amazing city. It's got the ports. It's got jobs. It's got the CBD. It's an established CBD. I think there's always going to be money made in Brisbane. I'm not comfortable with above Brisbane.
So you're talking about, so you wouldn't go to like the Rockhamptons, the Bundabergs, even the Sunshine Coast. You don't like the
Sunshine Coast. Yeah, yep. Just because there's a lot of land out there. I just feel that that's where house and land packages are going.
So Harvey Bay, not on Heather's list.
Flood, yeah.
Okay.
I don't want to.
All right, I like it. So
not on my list.
Mike, you promised a wild card. Where's this wild card that you're pulling out of your depreciation hat?
It's not from my depreciation hat. It's more from just observations. And the one observation that I've made is fundamentals are becoming less important in the short terms, and sentiment is just crazy. So what is going to be the best performing market? Well, where are the top 3 volume buyers agents putting their clients? I mean, that could be the answer to the question. And so where are they putting clients? Well, they needed to be an affordable market. They needed to be in a market with less competition, so they're not missing out on deals. So I feel like we could see something crazy happening from a place like Hobart. It might actually take more than 12 months, but something like that could it wouldn't surprise me. Do I sort of see?
That's not affordable though, Mike. I'm not seeing like you're paying. I mean, maybe Glenorchy or
it'd have to be one of those suburbs. So not inner city Hobart, but I don't necessarily see great fundamentals for that. But that's where I'm kind of thinking this is a new world of property investing that we're in here, and the ability for these aggregators, and you would say that this forum is an aggregator. If we got Joe and yourself and Palisi and maybe a few other guests to sort of talk about, or what will annoy Joe, Geelong, the Paris of the South. I mean, we could almost manufacture a boom if we can get 10,000 people investing in there, right?
Well, yeah. Whether we like it or not, Mike, there's a lot of people investing in some of the places you've mentioned. So, yeah, great. Okay, I like it, Mike. So I really appreciate this session. We've gone. I try and keep to an hour and a half these days, but we just had so many spicy takes, I couldn't do it. So, I'll let our guest co-host go first. Heather, if people want to get more of Heather in their lives, where's the best place to reach out to you and learn more?
DM me.
Okay.
I'm very relational. I want to know who you are and DM me. But, you can add my website as well, but just DM me. Yeah, I'm always in the chats. I'm always around. So say hi.
Be careful. Yeah, because you are doing some great stuff with the accounting sort of space and helping people out that want a more hands-on, holistic sort of planning focus, not financial planning, but the more budget planning kind of just where it's going to go.
Yeah, take into account everything that you need to bring together to make sure that you can actually grow wealth. Yeah.
Excellent. And Mike, I know you had your PIPA hat on, Property Investors Professionals, Property Investment Professionals Australia hat for this session to some extent. But where can people reach out to get more Mike Mortlock in their lives, whether that be PIPA or MCG?
I can't imagine that being a problem for a lot of people, Jeff. You can DM me, although I think I'm now like a middle-aged man. I've the algorithm's sending me all sorts of filth these days, so you could get lost in that sort of stuff. But you can go to mcgqs.com.au or give me a DM, but keep it clean if you don't mind.
And where's I do want to give a shout out to PIPA. So where is the best place for people to learn more about if they're, I suppose it is a property investment professionals association, but where can the general punter, like what are we getting from PIPA? What should we take away from them?
Yeah, well, I think anytime that we're sharing that survey, that's something that I would love people to be involved in. You can go to the PIPA website, which is pipa.asn.au, and get a copy of that survey. You can send me a message and I'll ping you one. I've got one handy as well. But look, there's lots of takeaways from those conferences as well, and that's open for people to attend. It's typically property investment professionals, but we do share quite a lot of data in the media and make commentaries about certain things that are happening. So if you follow PIPA on Facebook and LinkedIn, you'll be across all of that stuff.
And check out PIPA as well. I mean, I don't try not promote organizations too much, but check those guys out. They're
not for profit, Jeff. So it's all good.
Well, yeah, but I mean, I like to say whether it's for profit or not, I just like to say somewhat agnostic in terms of that. So what an amazing session. So good. Thanks, Mike and Heather. What about me, Marcy? What about Jeff? What did Jeff do? Did Jeff do anything? Yeah. No, that's all right. It's all good. Mike and Heather, I really appreciate you both coming on as guests and guest co-hosts. I haven't done the Spotify sort of plug, but if you've gotten value there's been so much wisdom shared from Mike and Heather in this conversation about locations, about where sentiment's going, about AI, and about why you shouldn't use ChatGPT for your depreciation. Give us a 5-star on Spotify so we can get more guests of this amazing caliber. So everybody, it's been an amazing session. Let's go and buy a property in 2026 or get a proper in-person depreciation. Thanks, everybody.
Thanks, guys. Thanks, Heather.
Thanks, Jeff. Holding it together always. You're amazing.